Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Dave Mazza, Managing Director at Direction Investments. And Direction, we know, is one of the largest issuers of leveraged and inverse ETFs. These ETFs are among the most misunderstood products in the ETF world. So we'll talk about how these ETFs work and how they should be used, particularly in a volatile market environment. And we will also discuss markets in general and the market outlook. Dave, welcome. Great to have you on the show.
Thanks for having me. Excited to be here.
So let's start with the recent market action, and what a roller coaster ride it has been. January was a terrible month for stocks. The S&P 500 lost 5.3%. The Nasdaq fell even more, losing about 9%. And these were the biggest drop for the indexes since March 2020. And high growth stocks suffered even worse. In fact, most of them were down more than 50% from their 52-week highs. And then suddenly, out of nowhere, we get this impressive resurgence, particularly in tech stocks. And stocks have been rising for 4 consecutive days now. And for the purpose of reference, we are talking on Wednesday, February the 2nd. So let's start with your thoughts on the recent stock market performance.
We really saw stocks begin to waver a bit going back into from November. And then this year, as we turn the calendar seemingly from 2021 and 2022, significant downside occurred. And I think much of this is actually quite healthy. We had not seen a correction in any material way, shape, or form in some time. But what's been challenging is when you peel back the hood, as you alluded to, there's really some really difficult performance. And much of that came from high growth names, especially more high growth small caps, more speculative type companies, many of which are found in thematic ETFs of every way, shape, or form. And that, I think, caught investors by surprise, the swiftness of that. And what we also saw is yields rise pretty sharply, especially 2-year yields, flattening the yield curve and getting people concerned about whether or not we are now the Federal Reserve is going to be hiking into an economic slowdown. But I think what remains through all of this is that we are in an environment where we are seeing rising inflation, fears of Fed tightening, but there's still some positive news. Earnings growth, not perfect across the board, has been really, really robust. And that's a positive. And it really, to me, that's been one of the main drivers of why stocks have found some recovery. And we've seen it with really impressive numbers out of Apple and Google of late, or Alphabet, I should say, that have really helped market sentiment.
So as you mentioned, investors are worried about rising inflation and rising rates. But the earnings picture has been robust, particularly by earnings by big tech, as you mentioned, Alphabet, Apple, Microsoft, AMD. They all have reported excellent results, and that is the reason why the market has rebounded, particularly tech stocks. So do you think the worst is over for stocks?
I don't. I think we are going to see ourselves in a volatile environment until we get to the Fed meeting in March. And I say that not to scare folks, but I say that because the big picture does remain murky. And plus now we have geopolitical risks out there, whether it's Russia or China, which in some way, shape, or form always exist, but they've really kind of come back to the forefront. So we have things that need to be worked through. I do think what we're going to end up is a real market of haves and have-nots. And some of this is simply going down to, what does the future outlook look like? Are companies raising guidance? So it's not even enough anymore to surprise to the upside. companies need to come out and say, you know what, we had a great quarter and we expect to have a great year in 2022. And those seemingly are the companies that are doing best. As opposed, so it's really about profitability versus unprofitability. The days of, I think, just identifying a disruptive company or ETF or what have you, and hoping for the best, maybe behind us until we work through some of these big picture items.
Okay, so let's talk a little bit about the best and worst performing areas of January. And we know that energy was the best performing sector in January. And in fact, energy was the best performing sector of 2021 as well. And as you alluded to, geopolitical risks, particularly in Russia and close to Russia and Middle East, they have also boosted energy prices. So your ETFs like Gush and ERX, they are among the best performing areas of the market in January. On the bear side, technology, biotech, and real estate, their bear ETFs did very well. Talk a little bit about the best performing leverage and inverse ETFs of January.
Yeah, really, we saw what I'll call the deep cyclical areas in our leverage lineup do best. And first and foremost, that comes to anything associated with energy or commodities. So our bull funds in the energy space, ERX, which provides 2 times bull exposure on energy stocks broadly. Gush is 2 times exposure on just your energy, your oil and gas exploration and production names. And then also Brazil. Our bullish Brazil fund, BRZU, had excellent performance as well. So it's all sort of the same theme there. But conversely, we saw bearish funds in areas like biotech. The ticker is LABD. And then also a bearish fund on internet stocks do exceptionally well. So again, this is almost just the flip side of that coin. As the spread between energy stocks on the positive side, and then your growth stocks and tech on the other side was really remarkable in January. As the market took a sharp hit down, but the rotation out of growth and into value was also accelerated by what was happening on the interest rate side.
So these were the best and worst performing areas of the market, but did investors chase performance? Did they put a lot of money in the hottest areas of the market, or were they buying some of the beaten down areas on dips? Which ETFs had a lot of attention from investors in terms of asset flows?
So really interesting things were occurring in our lineup in January. And it's categorized as, in my opinion, really 2 ways. One is that the growth investors, the tech investors, are not going to go down with a fight, meaning we saw exceptional flows, into SOX L, which is a bull fund on the semiconductor space. So it's a 3x fund on semiconductors. Also significant flows into our 3x biotech fund, which is LabU, and then also money moving into small caps and broad-based tech. So traders continue to buy the dip and position for this recovery. But at the same time, we saw the greatest ever inflows, and a few Fridays ago, the most ever inflows, the most ever trading volume for a fund called SPDN, which is not one of the largest funds in our lineup, but it's quickly becoming one, which provides just inverse exposure on a 1x basis to the S&P 500. So what this tells me is that more speculative traders who are willing to take on risk in their portfolio on a daily basis, we're ready to step in and buy. On the other hand, some people were looking for a hedge on the S&P 500 on the broad U.S. equity market. So an interesting bifurcation, but I think emblematic of the market sentiment we're seeing today.
Very interesting trends, and investors just love chip stocks. So we have seen whenever we see a sharp downtrend in chips, then investors continue to, traders in particular, start buying SOXL. And they were rewarded yesterday, right? AMD's results were so good, and yesterday and today. And that is why we have seen a nice rebound in semiconductor stocks. Now, I have seen that you publish a short-term ETF trading outlook. So I was interested in your thoughts on which areas of the market look attractive now.
Yeah, I think for traders that this environment is a really favorable one, because actually for a long-term investor, for a very, very long-term investor, volatility doesn't matter, right? They may not be looking at their portfolios. More intermediate-term investors can have a hard time waking up and seeing 10% corrections. But if you're willing if you are a trader, have a tactical mindset, this is a favorable opportunity for you. And where we're pointing toward folks is in fact some of the areas that saw some of the most interest from a performance perspective in January. I think if we believe that the Federal Reserve will continue the path and pace that they're now forecasting, then there's opportunities in financials, there's opportunities in energy, and then on the flip side, if we think that maybe we should be fading the Fed, which I don't know if I'm personally in that camp, but the market is two-way right now. There's a reason why, to your point, people continue to love the chip stocks. And in fact, the earnings numbers that are being put out by these mega cap semiconductor names are incredibly impressive. So to me, there's an idea that there's opportunities on both ends of the spectrum, but they may be more fleeting than they were, meaning the path going forward is just not, the rising tide will no longer lift all boats. It's going to be more selective.
So we know that leverage and inverse ETFs are very complex products, but these are also very interesting products. But I must add, they are appropriate only for investors who understand them properly. So for our listeners who do not understand how exactly these ETFs, these products work, could you please explain how these products work, how they achieve their daily exposure?
Yeah, happy to do so. And what I would say is, you don't need a PhD in finance or complex, sophisticated degrees to understand the products, but you do need to be comfortable with the risk that you're taking. Because what they're intended to do, whether we're talking about a 2 times exposure or 3 times, is provide amplified exposure on a daily basis. And this is often where some people can get hung up, meaning I'm bullish on semiconductors, for example, so I'm going to buy SOXL. Well, if you're not, the investment objective of the fund is to provide that return on a daily basis. So what can happen is they're not intended to be held for long time periods, because when we are in a more volatile environment like we are now, you could have some decay of returns by holding them, because the fund may not match up to what the long-term performance is, because it's not intended to. So what we kind of like to point traders and investors toward in this particular space is be comfortable with the risk that you're taking, that these products are providing, first and foremost, amplified exposure. So if your view is incorrect, you may lose more. You will likely lose more than if you're in a more traditional ETF. If your view is, of course, correct, you're going to do better. But the key period here is that you have to make, because of the daily reset, a daily decision. Am I buying the product? Am I selling the product? Or I'm holding it? Because when you get into environments of extreme volatility, where there's not just a clear trend, either up or down, these products are not going to match what maybe the weekly or monthly or especially quarterly or longer term results will be.
So could you also explain how exactly these ETFs achieve their daily exposure? Do they use some swaps like derivatives, futures. What exactly is the working behind the scene?
Yeah, so the way these funds work, I like to think about it as kind of the core one beta component provide with the amplified exposure. So what that means is that what we're doing is we have to seek on a daily basis that return of the S&P 500 or a semiconductor index. And so what happens is that this fund, what we use is primarily total return swaps, which is sounds complicated, but it's just a contract with the fund and counterparties, large banks, to deliver that result. So that's how we gain the leverage in the fund. And really one of the benefits there is it can be very costly, and it can be actually tricky for traders to take on leverage on their own with margins and things of that nature. So the fund is doing it, but we do need to be comfortable that this fund is going to be using different instruments to gain that exposure. And if markets are not trending in one direction, the performance, the daily performance will likely have a negative impact on those periods because we have to reset those swaps daily.
That's helpful, and it is very important for investors to remember that these products are designed to achieve their stated performance on a daily basis, and the performance can differ significantly from the stated daily performance objectives if they are held for a longer period. And as you mentioned, this compounding can have both favorable and adverse impact on the returns. And lately, trading has been marked by very intense volatility. We have seen these roller coaster rides, and there have been days where intraday swings have exceeded 6%. These products work best in trending markets with low volatility. So talk to us a little bit more about the impact of volatility on these ETFs, and whether investors should hold these products only for a very short periods when the market environment is very volatile.
Yeah, so I can't emphasize enough that these funds, whether bullish or bearish, whether 2x or 3x, or even lower leverage points, have a daily objective. So it's likely not going to meet the performance over longer time periods. Meaning, if I look at a particular index that's up 10% for the month, you'd say, well, I should be up or down 30 if I'm bullish or bearish. That's not how these work. So in more volatile periods, because the market conditions, because the performance is choppy, it will likely disadvantage any holding period that's beyond a day. So what we really encourage investors to do is to listen to conversations like this, or visit our website to watch some of the videos or our FAQs to understand the nuances here, because the math will play a role here. In trending environments where there's not as much volatility, you don't see the negative impact of compounding. You actually could see a positive impact. But the whole point here is anyone who's using these products should be comfortable with risk, but really be comfortable or better said, have the ability to monitor their portfolio over short time periods so that they can make those buy, sell, or hold decisions.
So could you talk a little bit about how these products should be used in a portfolio? Should they mainly be used for the purpose of hedging, or can they be used for amplifying returns, particularly when the markets are trending and volatility is low?
Well, they really can be used for both, and we see traders use them for both on a daily basis. And so, for example, if we're in the heart of earnings season here, and if I wanted to, and you noted earlier some excellent results from AMD and potentially others as we get the rest of semis reporting, that I'm bullish on the semiconductor space, and I think the earnings are going to be excellent for some of these names. On a day that a big name in the index is reporting, we tend to see people trade the SOXL, for example, or TechL, to take that bullish exposure. and then they might take it off the next day if they're right. Now, we also see traders and in some cases, longer-term investors using these products as short-term hedges. Let's say I have significant single stock exposure in the semi space or in the financial space, what have you, but I don't want to touch those underlying holdings. I could use a bear fund to offer a hedge in my portfolio, and that's really what we're seeing with our 1X S&P 500 fund, SPDN, as noted earlier. That they really can be used in both ways. So we tend to see more people using these funds, at least in the market environment we had been in, on that amplified short-term exposure in areas that were trending. Less on the hedging side, but we've seen that pick up even as people looking to amplify bullish exposure have not necessarily gone away.
Excellent. Now, switching gears a little bit, I also wanted to talk about some of your thematic ETFs. And while you have an excellent suite of inverse and leverage ETFs, you also have some very interesting thematic ETFs. And I've seen that you have been expanding that thematic ETF suite over the past couple of years, I saw some very interesting launches from Direction, like Direction Work from Home ETF, ticker symbol Moon. Then the Moonshot Innovators ETF, ticker symbol as Moon, very interesting ticker symbol. I also saw the Connected Consumer ETF, World Without Waste ETF. And then there are ETFs like Fallen Knives, Low Price Stock ETF, mRNA ETF. So which are your favorite thematic ETFs for 2022? Which of these areas do you expect to do well?
Yes, I'll hone in on a couple areas. So you noted that the Moonshot Innovators ETF, ticker Moon. This fund is intended to provide exposure to small, mid-cap, even micro-cap companies that are at the most innovative relative to their peers. And the way we measure that is a company talking the talk and walking the walk. So we use technology to scan corporate filings to see if the universe of names are using terms in their industry, so terms specific to biotech, terms specific to industrials, what have you, that are more innovative relative to their peers. And then we couple that with, are these companies actually spending in those areas? And we measure that by the amount of money they spend on research and development relative to sales. So this is a very, very unique ETF. It's almost like venture capital in an ETF. And it had particularly challenging performance in 2021 as traders and investors rotated out of some of the most innovative names and moved toward more safer names, more value names. But I think, again, once we maybe get some greater clarity on the interest rate picture, because some of these names that are in the portfolio, like Nikola, Virgin Galactic, ChargePoint, Ballard, they may be poised for a rebound. I think the next couple of months may be a bit challenging in this space continued, but the future remains really positive for these disruptive names. And then I'd also note we recently launched an ETF focused on companies that are involved with mRNA. And the ticker on that is Messenger, MSGR. This is another space that had saw really sharp. Biotech was out of favor for much of the last year. In the most recent sell-off, biotech was really hammered. But this is a space that we're really bullish on, even outside of the vaccine. And why do I say that? Because essentially the COVID-19, the pandemic, really solidified the fact that mRNA-based technology can have a lot of potential benefits to solve major diseases and major problems. So what this fund does is it provides exposure to a really narrow basket of companies that are at the forefront of using messenger RNA technologies. And as I noted, for years it struggled to gain acceptance, but because these companies showed, companies like Moderna and BioNTech showed the benefits that mRNA technology could bring to the COVID-19 pandemic, that funding is coming in at a sharp rate for other virus and diseases, everything from HIV/AIDS to Lyme disease. So it shows you how exciting that this particular space may be.
Very interesting. Moon and MSGR both are very interesting products. And that's all we have time for today. Dave, thanks again for joining us.
Thanks for having me.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.